Inno Holdings Incorporated, ticker INHD, is one of the more speculative micro-cap stocks listed on the NASDAQ, and it has drawn attention recently due to its highly volatile price action and unique approach to construction technology. The company is attempting to disrupt traditional building methods through mobile factories and a proprietary cold-formed steel framing system that it believes can improve efficiency, reduce waste, and ultimately lower costs in residential, commercial, and infrastructure construction. At first glance, this sounds promising because the construction sector is massive and ripe for innovation. But the reality of investing in INHD is far more complex, and it is critical for investors to dig deeper into the fundamentals, financials, stock performance, and risks before making any decisions. The core of Inno Holdings' business model is based on prefabrication and modular building methods. Instead of relying on traditional on-site wood or steel construction, the company has developed mobile factories that can be transported directly to construction sites. These mobile factories produce cold-formed steel framing systems that can then be assembled quickly, with greater precision and less material waste than conventional approaches. If this technology scales effectively, it could allow Inno to serve large-scale housing projects, commercial builds, and even industrial infrastructure with faster delivery times and potentially lower costs. From a purely conceptual standpoint, this represents a significant innovation in the construction process, similar in some ways to how modular housing or 3D printing has been proposed as a solution to global housing shortages. However, turning an innovative idea into a sustainable business is a very different challenge. When we look at the financials of Inno Holdings, the picture becomes far more sobering. Revenue remains extremely modest, coming in under $1 million per quarter. For a publicly traded company with national ambitions, this is a very small revenue base. At the same time, expenses remain high relative to that revenue, which means the company continues to post consistent operating losses. Over the trailing year, Inno's net losses exceeded $3 million, and there has been no clear trend toward profitability. The company's income statement shows a persistent gap between the cost of operations and the revenue being brought in, and without meaningful scale, this gap is unlikely to close in the near term. Cash flow analysis adds another layer of concern. Free cash flow is negative as Inno continues to burn cash to support ongoing operations, research, and development. With limited revenue, the company has no real operating cash inflows, meaning it relies heavily on financing activities and the cash it holds on its balance sheet. As of its most recent filings, Inno held roughly $4 million in cash. While this provides a temporary runway, that runway is short, especially given the pace of losses. Unless the company can either ramp up revenue significantly or secure additional financing, it faces the real risk of capital depletion, which could lead to either dilution through secondary offerings or debt issuance. On the balance sheet side, there are some positives worth noting. Total assets are approximately $9 million, while total liabilities are under $1 million. Debt is negligible, with less than $50,000 recorded, which means the company has not burdened itself with leverage. This is somewhat rare for a small-cap firm and gives Inno flexibility compared to peers that may already be highly indebted. However, while low debt is good, it does not solve the fundamental issue of weak revenues and negative cash flows. A clean balance sheet may allow management more room to maneuver, but without growth, dilution remains a major risk for shareholders. Turning to stock performance, this is where things become especially volatile and speculative. Over the past year, INHD shares have collapsed more than 80%, falling from levels above $20 to barely over $1. At one point, the company executed a 1-for-10 reverse stock split to maintain its NASDAQ listing compliance, which highlights the severity of the decline. Despite these challenges, the stock has also experienced short-lived speculative rallies. In spring of 2025, shares spiked dramatically before quickly reversing, a pattern that resembles pump and dump activity often seen in thinly traded microcaps. Such volatility underscores the speculative nature of this investment. For traders, this volatility may present opportunities, but for long-term investors, it represents a significant red flag. technical analysis reinforces the bearish picture. Moving averages across short, medium, and long timeframes are all trending downward. The 50-day and 200-day moving averages remain well above the current price, suggesting persistent downward momentum. Relative strength index readings have frequently dipped into oversold territory, though these levels have not led to meaningful reversals. The MACD indicator has also reflected weak momentum, with bearish crossovers dominating. From a chart perspective, there is no clear support level beyond the $1 mark, and resistance levels remain well above where the stock currently trades, meaning that any sustained recovery would require a fundamental shift in investor sentiment. When we examine fundamentals more deeply, including profitability ratios, the challenges become even more apparent. Return on assets and return on equity are both deeply negative, reflecting the fact that the company generates consistent losses without producing a return on shareholder equity or its asset base. Gross margins, while positive in theory due to the nature of prefabrication, are outweighed by high operating expenses. As long as revenue remains low, scaling margins upward is nearly impossible, which means the company cannot rely on efficiency improvements alone to reach profitability. The cash conversion cycle is also weak because the company lacks recurring revenues and has not established a large customer base. From a strategic standpoint, Inno Holdings operates in an industry that is both enormous and highly fragmented. The global construction industry is worth trillions of dollars annually, and innovations that improve efficiency are desperately needed. Housing shortages, infrastructure backlogs, and labor shortages have made prefabrication and modular construction increasingly attractive. Competitors such as Katera, Boxable, and other modular housing startups have all attempted to disrupt the space, with varying degrees of success and failure. Many of these companies have struggled with execution, funding, and scaling, which demonstrates how difficult it is to break into an entrenched industry like construction. Inno has the advantage of a novel approach with its mobile factories, but it still faces the same hurdles of adoption, scaling, and financial sustainability. Looking at the risk profile, the most obvious risk is continued capital burn and dilution. With negative cash flow and limited revenue, the company will almost certainly need to raise additional capital in the future. For current shareholders, this represents a dilution risk that could erode ownership stakes and depress share value further. Another major risk is delisting. Although the company executed a reverse split to maintain NASDAQ listing standards, if shares continue to languish near the $1 level or below, there remains a threat of non-compliance and potential removal from the exchange. A delisting would further reduce liquidity and investor interest, which would be devastating for shareholder value. Beyond these, there is execution risk. Can management actually deliver on its vision of scaling mobile factory production and achieving revenue growth, or will it remain stuck in the prototype and pilot project phase? There are, however, potential opportunities worth acknowledging. If Inno Holdings can secure large contracts or partnerships with developers, governments, or infrastructure projects, revenue could ramp quickly from its currently small base. Because the company has little debt, it has more flexibility to structure deals or raise additional capital without the burden of high interest payments. If the company demonstrates traction in its technology, investors could re-rate the stock significantly higher, given its current depressed valuation. Additionally, the prefabricated and modular construction space remains attractive to policymakers and urban planners, meaning that Inno could benefit from broader tailwinds if governments push for innovative solutions to housing shortages. Ultimately, the investment thesis for INHD comes down to a simple but high-stakes bet. On one hand, the company has innovative technology, low debt, and a potentially massive addressable market. On the other hand, it has negligible revenue, persistent losses, negative cash flow, and a history of severe stock volatility. For most investors, this makes INHD an unsuitable investment, especially for those seeking stability, income, or steady growth. For highly risk-tolerant traders, however, INHD may represent a speculative turnaround play, one that could deliver outsized gains if management secures contracts and executes effectively. But this remains a very big if. In conclusion, Inno Holdings is a stock defined by volatility, uncertainty, and speculation. Its mobile factory technology may one day disrupt traditional construction methods, but today it remains unproven and underfunded. Investors should approach with caution, recognizing that this is not a typical growth or value investment, but rather a high-risk micro-cap gamble. Exposure, if any, should remain very limited, and investors should be prepared for the possibility of further declines, dilution, or even delisting. For those who believe in the long-term potential of prefabricated construction and are willing to take one extreme risk, INHD may be worth monitoring. But for most, the risks far outweigh the potential rewards at this stage.